Let me paint you a picture. You've just gotten the call. Maybe it's a promotion. Maybe it's a new job offer. Either way, the number they said, your new salary is more than you've ever earned. And for a moment, maybe just a few hours, you feel it. That quiet exhale. That sense that things are finally going to be different. You do the rough math in your head. You think about what you'll pay off first. You think about whether you can finally stop checking your bank account before you buy groceries. You think honestly that this is the moment things shift. And then 6 months go by. And somehow, it doesn't feel that different. The account isn't growing the way you imagined. The stress hasn't really lifted. You're not broke, but you're not where you thought you'd be either. And that's when a quiet, uncomfortable thought creeps in. Asterisk, where's the money actually going? That question, that's what this video is about. Because I think most people assume the answer is lifestyle, that they spent more, upgraded things, got a little loose. And maybe some of that is true. But what nobody tells you, what doesn't get talked about in the salary negotiation videos or the how I make six figures content, is that a significant portion of your raise was already spoken for before you even got it. There is a silent tax on a good salary, and it's not what you think. Here's the assumption most of us carry into earning more money, that a bigger number means a proportionally bigger life. If I earn 30% more, I'll have 30% more breathing room. That's the mental model. It's logical. It's also wrong. And it's not wrong because of anything you did. It's not about discipline or budgeting or willpower. It's wrong because of how the systems surrounding your income are actually designed and how they quietly recalibrate every time you move up. We talk a lot about lifestyle inflation, which is real. But there's another kind of inflation that doesn't get nearly enough attention. It's structural, it's automatic. It happens before you make a single decision. And it compounds in ways that most working professionals have never sat down and actually looked at. I'm not talking about anything conspiratorial. I'm talking about very boring, very real mechanisms, tax brackets, insurance premiums, housing costs, that essentially pre-consume the upper portion of your income before you experience a single dollar of it. And the psychological damage that does, that gap between what you expected and what you feel, is something I think we dramatically underestimate. Let's start with taxes because it's the most obvious one. And also the most misunderstood. There's a myth, and it persists even among fairly educated people, that getting bumped into a higher tax bracket means you suddenly take home less money overall. That's not how marginal tax rates work, but the confusion matters because it shapes how people feel about earning more. Even people who intellectually understand progressive taxation often don't feel it clearly when they see their paycheck. Here's what actually happens. Say you get a raise that pushes part of your income into the next bracket. Only the portion above the threshold gets taxed at the higher rate. The rest stays the same. So you're always better off earning more, technically. But, and this is the part that stings, the effective benefit of that raise, after tax is smaller than the number they told you. Sometimes meaningfully smaller. If someone offers you a $15,000 raise and your marginal rate on that extra income is, let's say, 32%, you're actually taking home closer to $10,000 of that raise in net pay. That's not a tragedy, but if you planned your life around of breathing room and only felt, that gap creates confusion. And confusion financially often leads to quietly filling the space with spending because the relief you expected never fully arrived. Then there's insurance, and this one doesn't get talked about nearly enough. The further you move up in income, especially if you're self-employed, moving to a new employer or crossing certain thresholds, your insurance costs tend to climb. Health insurance, particularly if you're in a country like the US, crossing income thresholds can affect subsidy eligibility. If you're in a role with better benefits, you might actually be paying more in premium contributions than you were in a lower paying job with different coverage. And as you earn more, you often feel socially pressured or logically compelled to upgrade coverage. Add life insurance, income protection. All reasonable, all real cost. Nobody sits down and tells you congratulations on the new salary. By the way, insurance and related costs are going to absorb roughly this much of that. Just happens quietly. And then there's housing. This is the biggest one. There's a well-documented phenomenon where housing costs undesirable. Areas track income growth not with a delay, but almost simultaneously. The neighborhoods, buildings, and lifestyles that feel appropriate to your income level price themselves accordingly. Not because of anything sinister, but because you and thousands of people like you are all earning more at the same time, and you're all looking at similar places. What this means practically is that when your salary grows, your housing options often grow in ways that consume the delta. The upgrade from a $1,400 apartment to a $1,800 apartment feels modest, justified even. But that $400 a month is $4,800 a year, nearly half of the after-tax version of a modest raise. And here's the part that makes this genuinely hard to see. None of these things feel like splurging. You're not buying a boat. You're not taking extravagant holidays. You're paying for a slightly better place to live, keeping up with health coverage, and watching taxes do what taxes do. You're being, by most people's standards, responsible. And yet somehow, the raise doesn't feel like a raise. Now I want to bring in something called hedonic adaptation because it sits underneath all of this. It's the psychological mechanism by which we return to a roughly stable level of emotional satisfaction regardless of what changes in our circumstances. You get the raise, you feel good. 6 weeks later, the raise is just your salary. The new apartment is just where you live. The improved coverage is just what you have. The brain is extraordinarily good at normalizing. And when normalization happens before you've actually felt the financial benefit of the raise, because the structural costs consumed it first, you're left in a strange psychological limbo. You earn more, you feel the same, and that dissonance is genuinely disorienting. Research in behavioral economics has shown that people in this position often respond in one of two ways. They either start spending more on smaller things, meals out, subscriptions, small luxuries, to try to manufacture the feeling of abundance that the salary number suggested, or they become anxious and vigilant, checking accounts more, feeling like something must be wrong with them, that they must be bad with money. Neither response is irrational given the experience, but both are triggered by something structural, not personal. So what do you do with this? I want to be careful here, because I think the wrong response to all of this is to feel trapped or cynical. The point isn't that earning more is pointless. It's not. Earning more is genuinely meaningful. It creates options. It creates security. It creates over time real freedom. But the shift I want to offer you, the thing that I think actually changes how you experience your income, is moving from passive assumption to active accounting. Most of us negotiate a salary and then experience whatever we experience. We don't sit down and actually model in advance what a raise realistically means in take-home terms. We don't think through how our fixed costs are likely to shift. We don't ask, if I move for this job, what does housing cost there? And how does that interact with the pay difference? When you start doing that, and it doesn't need to be complicated, it can be a one-page, rough calculation. The gap between expectation and reality shrinks. Not because the structural costs disappear, but because you've already accounted for them. Going in that $20,000 raise might functionally feel like $8,000 of real new. Space after taxes, insurance adjustments, and a modest housing change, and $8,000 of real new space is meaningful. But you plan around $8,000, not $20,000. That shift from gross to effective changes everything about how you make decisions. It also changes what you negotiate for, because once you understand the structural drag, you start seeing clearly that salary isn't the only lever Employer-paid insurance matters. Remote work or flexible location matters, because it can mean you're not living in the highest cost market tied to your employer's zip code. Equity and deferred compensation structures matter. These aren't abstract HR concepts. They're levers where they sit outside the taxable income structure and can dramatically change your effective financial position. Let me make this concrete without it becoming a lecture. If you've had a raise in the last year or two and you're sitting here feeling like it didn't quite land the way you expected, the first thing I'd encourage you to do is just pull the actual numbers. Not how much they said you'd make, what actually hits your account each month. Then look at your 3 largest fixed costs: housing, insurance, or health-related expenses. And whatever debt obligations you carry, add those up. See what percentage of your take-home they represent. For most professionals earning a decent salary in a major city, that number is between 55 and 70%. Before food, before transport, before anything resembling a choice. That's not a judgment. That's just a number worth knowing, because once you know it, you can have a different conversation with yourself. The question stops being, why can't I seem to get ahead, and becomes, given my actual structure, what does getting ahead realistically look like for me right now? And sometimes the answer is, the salary leva is largely tapped out for now, and the next meaningful move is on the expense side, not dramatic sacrifice, but strategic reduction of one of those 3 big fixed costs. Sometimes it's looking at the income structure differently. Freelance income, a side project, something that sits outside the primary tax exposure. Sometimes it's recognizing that the foundation is actually fine, and what's needed is patience and time, not a dramatic change. The point is clarity, because clarity is calming, and calm is underrated in personal finance. I want to end with something that I genuinely believe. The fact that you feel confused about why your money doesn't match your income is not a character flaw. It's not laziness. It's not bad math on your part. It's the natural result of a system that isn't designed to be transparent about how it works. The structural costs of a professional income are real, they're significant, and they are almost never part of the conversation when salaries get discussed. Knowing that, really sitting with it, should, I hope, dissolve some of the quiet shame that tends to accumulate around money, the shame of earning well and still feeling stretched, the confusion of doing most things right and not feeling financially free. That confusion makes sense now. It's not you. It's the architecture. And here's the thing about architecture. Once you can see it, you can work with it. You can't change tax brackets tonight. You can't wish away the cost of housing, but you can make decisions that account for reality rather than assumptions. And that, quietly and over time, is how people actually make progress. Not in one dramatic move, not because they found some secret, but because they stopped being surprised by systems they finally understood. So if this video gave you one thing, let it be that. A little more clarity, a little less confusion, a slightly more accurate picture of where you actually stand. That's enough for today. The rest follows from there.